It's continued to remain flat. Nifty Bank Index marginally in red. One stock that we need to focus on is Nalco. That stock is up around 17% in the last 4 trading sessions. So keep an eye out for that stock in trade. Moving on, Vikas Goel, the MD of PNB Gilts, is joining us to tell us about the impact of the falling yields and the fact that interest rates are expected to fall from the next calendar year, that is 2024. Firstly, in the last week, if you see, Mr. Goel, yields have come down from 7.28% to 7.16%. Does this have any impact on your business?
Yes, of course. As you're aware, we are traders in gilts, in government securities. So as yields fall, prices rise, and that is good, news for our business. Yields falling is really good news for our business.
Well, yields falling will definitely result into higher profitability. Can you confidently say that?
Yes, for us, as I said, we are interest rate sensitive. So as the cycle turns and rates fall, that is good for our business. And obviously, the assets which we hold, they get repriced at higher prices. Therefore, we have MTM or slash trading gains. So generally, that, like I said, it is good news for our business.
Given that yields are falling now in the next calendar year, the entire market is expecting that the interest rate cycle is also expected to start come down, is also expected to fall now going forward. So how will that impact your profitability or your business working?
So essentially, it is a function of how much risk we take. Generally speaking, if you have gone by our past performance, as cycles, interest rate cycles favor us, which basically means the cycle turns down, which is what it is expected to do next year. Our profitability is then becomes a function of the amount of risk which we are taking on our books. We are a trader in government securities. So essentially, as there are more and more opportunities, we tend to be far more profitable than when the cycle is flat or when the cycle is an up cycle. So essentially, it's a function of the amount of risk which we are taking, which can be seen at least in public domain in the size of our balance sheet and the tenor of the securities which we are holding in that balance sheet. Longer the tenor, more sensitive they are to interest rate movements. And if rates are coming down, prices are going up, longer end will outperform, or longer duration securities will generally speaking outperform shorter end securities. So it's a combination of carry income because generally front end rates fall, your margins increase in terms of net interest margin also increases because the assets which we are holding are fixed rate. So our net interest income increases quite apart from trading income, as I said earlier. So overall, both the major sources of income, trading first and second, net interest income, both become favorable for us in a falling interest rate environment.
Okay. Sir, just wanted to understand, in the calendar year 2024, other than the JP Morgan bond inclusion, is there any other major event related to the debt market that investors should watch out for?
Yes. So as you rightly said, one is JP Morgan bond index. The other thing which you need to watch out for, or all investors, not only in PNB Gilts, but basically fixed income investors need to watch out for is what Reserve Bank does with monetary policy. So essentially, one indication which you can get is what the Fed has done already, the US Central Bank. So essentially, they have signaled that they will cut rates a minimum of 3 times that quarter point cuts, which is essentially 75 basis points from a historic high of 5.25 down to 4.5, 4.75. So that will also force Reserve Bank's hand at the minimum to change its stance from withdrawal of accommodation. It will change its stance to neutral, as well as reinstating liquidity, which hopefully will bring down effective funding rates from 685 presently, 680.85 to maybe 630. And that is what has been indicated by the derivatives market, particularly the interest rate swap market also. So essentially, the other thing, apart from index inclusion, which is the flows from there are view agnostic. So whether rates are going up or down, you will see the flows come in. Quite apart from that, will be monetary policy moving from a tight monetary policy to a much more easier monetary policy, it looks like next year. So these are the two major events which we need to watch out for in 2024.
Right. Good afternoon, sir. This is Cheryl also joining in the conversation, and let's actually switch gears and talk about your Forex business. If you would help us understand how is that business actually shaping up for you, and also to add to that, if you can tell us how can we expect all of these events to actually reflect in your books when it comes to the year FY 24-25.
So first, let's talk about Forex business. As I've said time and again, it is a business which Reserve Bank allowed us a license to diversify our revenue stream. It is not going to be a major business. Our major business continues, or core business continues to be government securities trading, market making, and underwriting the government's borrowing program. So that is the major. We are interest rate players. That continues to be so. As a diversification of revenue stream, we will also obviously start our FX business. We are at a stage where essentially we will start by the end of this year. So by April 1st, we should be full on with our business in terms of both infrastructure, human resource, so on and so forth. So we are at an advanced stage of implementing against our business plan, and that business should start. From non-core businesses, as I've said earlier, what we expect going forward is about 10% of our bottom line should come from non-core businesses, which also includes DCM, fees and so on and so forth, FX business, our sales business. So the sales and distribution business, which is apart from the core business of trading fixed income. So essentially, we are looking between 10 to 20%, 10% to begin with, and hopefully bring it up to about 20% of our bottom line in terms of a diversified revenue stream. So that is on the FX part. Now, apart from FX part, what we intend to do going forward, like I said earlier, talking with Sumit, is that the market looks very conducive for us, for our core business going forward in 2024, both from viewpoint of index inclusion, which is view agnostic, as well as from the fact that monetary policy might change from being very tight to maybe being more relaxed, may I say, and that will be favorable for our core business. So essentially, we are looking at a year which will be good. Now, can I make a forward? As you are aware that we are in an uncertain environment, the risk to this view that it will be good is, one, there is geopolitical risk, as you are aware. There is global uncertainty. Headline inflation, particularly food and to some extent energy also, is pretty volatile. So that can be a risk to our business, both are risk to our business, to this view. Broadly speaking, I would say that if you have seen a cycle over the last 4 years, we are at the cusp of what happened 4 years back. So essentially, rates will start trending down from next year. We'll gather pace the year after next, and then maybe stagnate a bit, and then look to go up 3 years hence. Having said that, our business is not such that we can make such long calls. So it comes with a lot of disclaimers. And I have already mentioned the risk to this view. So we are still in an uncertain environment. But broadly, it is looking favorable, at least next year. I mean, that's as far as I can make, so to speak, give you a forward view on our business. We are not, numbers kind of people. You have seen the volatility in our results. That reflects the volatility in markets. So since we are traders in markets, that's our core business. Our income is also impacted by the uncertainties in the market.
Thank you, Mr. Goel, for giving us all those details and to put things into perspective.